Hello, this is Professor Hazara again, and we've got three more videos to do in this for this week on um, international transactions. What I'm going to show you now is just the very basics. You could have 2-year courses on this stuff, but this is stuff that you got to know for the CPA exam. At least some of the concepts and the principles that I showed you before were the old way to do it, and some of the logic is still there, but the types of hedges, at least you should know the terms and the general, um, say the general concepts underlying the principles, at least the major rules for these new types of hedge definitions and how they're accounted for. And that's the point of what I'm doing. So I'm going to just have three videos. The first one's going to be another 3 minutes. I'm just going to give you the basics, sort of a setup video. And then we're going to have two more videos. One is on what are called cash flow hedges, and you'll see at least how the principles work. And the other one is are called fair market value hedges, which is I'll show you how the principles work there. But really, I mean, you could spend days and even semesters on this stuff because it does involve financial derivatives. And we used forward contract financial derivative. It's very simple financial derivative. You can think of options, swaps, all types of things. And so you'd have to find there's experts in this entire thing. Anyway, but you should know some of the concepts. Okay, so let's just go over to the PowerPoint here. I don't know why I have the Washington Post there. Usually have my desktop to start. But anyway, okay, I'm just going to give you 3 slides here. Preliminary to contemporary hedge counting. The hedge counting that I showed you in the previous videos or these chapters, whatever, while a bit old, I have learned that a mastery of the basic hedge accounting that was previously used facilitates the learning of the new accounting standards. Basically, the logic that that hedge offsets some previous transaction, that they perfectly offset each other. Understanding that is very important to understanding these new principles, because the same thing happens. You'll see that in the end here, the same thing happens. The problem is that the principles now don't ask you to record the contract receivable, contract payable. You're just going to record the loss or the gain on the contract, and use that to offset the loss or the gain on the receivable or payable. And so if you kind of have the previous, let's say, principles way of doing it as a framework to understanding this stuff, then it makes life easier, especially on cash flow hedges. Okay, there are now 2 types of hedges. I'm just going to do 2 more slides and stop. First ones are cash flow hedges. Now there's just various dozens of types of both these types of hedges you could come up with. But these are typically used to hedge the value of receivable or payable in a particular transaction. Like the transaction we just had. We sold something on credit and we hedged the cash on the receivable that we were going to get. Or we bought something on credit and then over the next 3 months we had to pay off a payable and we hedged the cost of the payable of getting the foreign currency. Those are typical cash flow hedges. Now, a new principle is 2 things, really. I put one here and the other one I'll just explain. The exchange of losses on these types of hedges, on cash flow hedges, are close to OCI. So we'll have a hedge on a receivable, let's say, and we'll have an exchange gain, and we'll close it to OCI. And then we're going to have the corresponding hedge on the, let's say, contract payable in this case would be also close to OCI, and they offset each other. Okay, and that's the first thing. And then, like I sort of tried to hint in the last video of last time's video, is ultimately, mechanically speaking, it doesn't matter how you do the accounting. Ultimately, it's really the premium or discount of the forward contract that will be the cost or benefit of the hedge. Apart from your hedge is minimizing it, but you're paying a cost, and it's usually the premium or the discount on the forward contract. That's the first rule. The other thing is that unfortunately, under the new standards, rather than just amortizing premium or discount on forward contracts using a straight line basis like we did in the first 5 videos, the first section of this, unfortunately now we're going to have to use the effective interest method, which makes things a little more complicated. So basically, remember 2 things for cash flow hedges is that gains and losses on these hedges are close to OCI. Gains and losses on everything hedge are close to OCI. And then ultimately, the premium or discount are what will impact income, really. And then Unfortunately, we have to use the effective interest method on this. Okay, and the next type of hedge are fair market value hedges. These are just typically these are much easier than cash flow hedges. You're just going to have a gain or loss, and assuming it's an effective hedge, that let's say it's 100% effective, your hedge item, then it's the effective part of the hedge is close to net income. I don't want to get into hedge effectiveness, but basically we're assuming in this course that every hedge is 100% effective. If the account receivable, you have an exchange gain of $1,000, then on your contract payable, you have an exchange loss of $1,000. In the real world, it doesn't always work that way. That the hedge instrument, which would be your contract receivable or payable, your forward contract, they would be, but there are types of derivatives which would only be 80 or 90% effective against a hedge. But anyway, so we're not going to deal with that though. So we're going to stop here, and then we will start with the example and get ready of. That's why I say look out here on a cash flow hedge example. Okay, so I'll stop this video.